Hi, I'm Doug Carroll. Welcome to the module on money market instruments, municipal securities, and asset-backed securities. This grouping of topics is intended to facilitate a relatively comprehensive overview of the U.S. fixed income markets in only 8 modules. This topic coverage might seem arbitrary given that a number of other sectors had dedicated modules. However, the modules focused on individual sectors were devoted to the 3 largest segments of the U.S. fixed income markets: Treasury securities, corporate securities, and mortgage-backed securities. In the aggregate, those sectors account for about 3/4 of the U.S. fixed income markets by dollar value of securities outstanding. The 3 sectors covered in this module account for the remaining quarter or so of the market. This module, dealing with money market instruments, municipal securities, and asset-backed securities, will be divided into 3 segments of approximately equal length, one for each of the sectors being covered. Within each sector segment, the presentation will begin by identifying the defining contract or market features that distinguish securities in that sector from the securities traded in other fixed income market sectors. The introduction to each sector will include a discussion of the general investment characteristics of securities from that sector. After the introduction and overview to each sector, the presentation will investigate in detail some of the more prominent security types from within that sector. Here the discussion will address a range of topics including review of the legal structure of issuance, sources of cash flows to be paid to investors, factors that might cause uncertainty regarding the timing or amount of the cash flows, and any protections investors have beyond the obligation of the issuer to pay, among other factors. Let's begin the segment on money market instruments. Though it may sound like a misnomer, money markets is financial industry jargon for the market segment dealing with the issuance, trading, and investing in short-term, high-quality debt securities. There is usually thought to be so little risk in holding these securities that they are almost as safe as holding money. Money market instruments are also known as cash equivalents, especially when these securities are being discussed in the context of portfolio management or asset allocation. The most distinguishing characteristic of these securities is that they have very short times to maturity from issuance. A year or less to maturity from issuance is the generally recognized definition that distinguishes money market instruments from other fixed income securities. In practice, the vast majority of money market instruments are issued with significantly shorter maturities, most probably having initial terms to maturity of 3 months or less. In fact, a significant portion of the sector is comprised of overnight investments. While the initial short term to maturity is perhaps the most salient characteristic, the other common features are a high degree of safety and relatively good liquidity. True money market instruments carry the equivalent of an investment-grade credit rating, otherwise they would not be considered money market instruments. The combination of short maturity and high credit quality makes money market instruments relatively easy to buy and sell, so they exhibit relatively good liquidity despite small issue size in many cases. Beyond the investment characteristics just described, there are various contract features common to all or significant proportions of the instruments traded in the sector. Unlike most fixed income securities, which are usually quoted on a price or percent of par basis, money market instruments are usually quoted on a rate basis. Confusingly to people new to the fixed income business, the specific type of interest rate quotes vary by security, and different rate quotes are not directly comparable. Most securities in this sector would either be quoted on a discount rate basis or a money market rate basis. We'll consider those 2 types of rate quotes in a few moments. Also, unlike bonds, which generally pay interest over time in the form of a periodic coupon, interest on money market instruments is typically payable at maturity along with the return of principal. The specific form of the interest payment varies across security types. The single payment to the investor at maturity might be in the form of a principal amount along with a coupon. However, for some money market instruments, the payment at maturity is for exactly the face amount, the interest earned at maturity equaling the discount from face at which the security was purchased. U.S. issued money market instruments also use a different day count convention than other sectors of the fixed income markets. Whereas other sectors of the fixed income markets use either a 30-360 or an actual day count convention, money market instruments in the U.S. generally use the actual over 360 day count. Before considering any particular type of security in detail, let's do a quick overview of the major types of instruments traded in the money markets, identifying those to be covered in this session. Some money market instruments are covered in modules dealing with other sectors, such as treasury bills, agency notes, and federal funds. Another, municipal notes, belongs to a sector to be covered later in this module. The money market instruments we'll discuss during this segment can be separated into two categories of securities based on the way interest is paid to the investor. First, the presentation will cover several types of discount securities, commercial paper and bankers' acceptances, securities entitling the holder to only a single cash flow, the face amount at maturity. After discount securities, the discussion turns to several instruments that pay the investor principal plus interest at maturity, negotiable certificates of deposit, as well as repurchase agreements and reverse repurchase agreements. Before discussing any of the individual instruments, let's consider the implications of whether a particular instrument is considered a discount security or is an interest-bearing security. In general, money market instruments can be separated into the two broad categories previously introduced: discount securities or interest-bearing instruments. As indicated earlier, the holder of a discount security receives only a single cash flow, the face amount payable at maturity. There are no interim cash flows such as periodic coupons. The face value at maturity is the only payment promised to the investor in return for the price paid at purchase, whether the security was bought at issuance or in the secondary markets. As long as interest rates are positive, such securities will typically be issued and traded at a discount to face, ergo the name. For an investor that buys a discount security and holds to maturity, their interest for holding to maturity would be the discount from face at which the security was initially purchased. The interest-bearing instruments are typically issued or created at face value or par. So the investor is paying, really lending, the full principal at purchase. At maturity, the investor receives in return the original principal plus interest. So the maturity value is normally above the face value by the amount of interest earned. The instruments usually issued and traded as discount securities are T-bills, agency notes, bankers' acceptances, and most commercial paper. The last two on that list will be discussed as part of this module. Interest-bearing money market instruments include municipal notes, federal funds, negotiable certificates of deposit, and repurchase agreements. Again, the last two will be covered here in some detail. Recall the convention for quoting money market instruments. Usually they are quoted on a rate basis. However, the different styles of interest payment lead to different conventions for determining the relationship between rate and price. Discount securities are quoted by an interest rate known as a discount rate. The interest-bearing money market instruments pay what's referred to as a money market rate. Unfortunately, the rates by which the different types of instruments are quoted are not directly comparable. To be able to make an apples-to-apples comparison, the rates need to be put on a common footing. This is normally done by converting the discount rate to a money market equivalent yield. The specific methodology for making that conversion is beyond the scope of this presentation. However, it's important to reinforce the general principle that any time one is comparing different securities, the conventionally calculated rate quotes are not necessarily directly comparable. Rates on securities from different sectors may need to be adjusted to make them directly comparable, thus enabling investors to make a more valid assessment of risk and relative value. Let's consider several of those money market instruments in detail. First up, commercial paper, or CP as it's occasionally referred to. Commercial paper is a type of corporate debt instrument. Commercial paper is sometimes described as a corporate IOU or promissory note. That's a roundabout way of saying the debt is unsecured. It's backed only by the issuer's promise to repay, but without the pledge of specific assets as collateral. Occasionally, commercial paper will be issued with a coupon attached, typically a single coupon due at maturity. But that's not the most common form. The vast majority of commercial paper offerings are sold as discount securities. When introducing money market instruments earlier, 1 year was identified as the generally accepted maximum maturity for instruments in the sector. But for commercial paper, the maximum maturity cannot exceed 270 days. The shorter maximum maturity has to do with a provision in the securities laws placing certain requirements on corporate debt issues. Public offerings of corporate debt securities above a certain size are required to be issued under the terms of a contract known as a trust indenture. In simple terms, the contract specifies the terms of repayment, any other obligations placed on the issuer, and the rights of the bondholders. Issues maturing in 270 days or less from issuance are exempt from the requirement, thus enabling avoidance of significant legal and administrative expenses as long as maturity conforms to that limit. Though 270 days is the maximum possible maturity, the majority of commercial paper has significantly shorter maturities, often 3 months or less from issuance. As investments, bankers' acceptances are very straightforward. They are discount securities, so bankers' acceptances exhibit the same cash flow patterns and are quoted on a rate basis just like treasury bills or commercial paper. On the other hand, there is a complex story that stands behind the creation of that simple investment. Bankers' acceptances are normally the result of trade or inventory financing arrangements. Usually it is international trade financing, though some arise in the context of domestic transactions. Let's consider a common commercial action that would lead to the creation of a banker's acceptance. The purchase by a domestic company of goods produced by a foreign company, where the accepting bank is providing trade financing to the domestic company. Assume a transaction is being negotiated between a domestic corporation and a foreign producer for the delivery of a specified quantity and quality of some product at a particular time and place. The foreign producer wants near absolute certainty of payment before incurring the expense and risk of fulfilling the purchase order. So the domestic corporation is likely to engage a domestic bank with expertise in international trade finance. Upon agreement with the domestic corporation, the bank will agree to provide financing for the trade and become the accepting bank. Upon confirmation of a legally binding agreement to the commercial transaction, the domestic bank will issue a letter of credit on behalf of the domestic corporation. The letter of credit will be for a stated amount of money payable on behalf of the domestic corporation, guaranteed by the accepting bank, upon fulfillment of the purchase order. For example, delivery of specified goods to the buyer's facilities. Or perhaps goods shipped, freight on board, and bills of lading transferred to the accepting bank. The letter of credit will be sent to the foreign producer's in-country representative bank. That bank will confirm its receipt to the producer, indicating that the financing is in place for the foreign producer or seller to be compensated. Upon fulfillment of the contract terms, say goods produced and shipped freight on board, the foreign producer will notify their representative bank, which in turn will send a draft for payment from the accepting bank. The accepting bank will review the supporting documentation to ascertain the contract terms have been satisfied. If so, the draft will be stamped accepted, ergo the appellation banker's acceptance. The draft has likely been accepted by the bank well before payment is due from the domestic corporation. The bank could simply hold the accepted draft as an interest-earning asset, but it likely has higher return uses for any funds. The banker's acceptance will be sold to investors, rediscounted is how it's expressed in the business, at a discount to face to mature shortly after payment is due from the domestic corporation. As investments, bankers' acceptances are considered extremely safe, as they are guaranteed by the accepting bank, give the holder a claim on the payment due from the domestic corporation in case of default by the bank, and a legal claim on the goods or commodities whose purchase was being financed. There has never been a default on a banker's acceptance issued by a U.S. banking corporation. On to the interest-bearing instruments up for discussion. First, negotiable CDs, or more formally, negotiable certificates of deposit. Certificates of deposit, or CDs, are a type of bank deposit. The certificate cited in the instrument's name is a reference to a literal paper certificate that indicates ownership of the deposit. CDs are a type of instrument known as time deposits. Time deposits are deposits where the depository institution can either put a hold on withdrawal or impose a penalty for early withdrawal. Negotiable CDs are not those being advertised on rate boards in the typical bank lobby. Those deposits are also CDs, though they're not typically negotiable. To be negotiable, certificates of deposit must be for $100,000 or more. Most are for significantly larger amounts. On the institutional side of the market, $10 million is often a normal trading lot. The advantage of negotiable CDs over non-negotiable time deposits is the ability to obtain funds prior to maturity without suffering a penalty for early withdrawal. No penalty needs to be incurred, as the investor needn't withdraw funds from the deposit. Rather, the depositor would negotiate a transfer of ownership or sale of the deposit to some other investor. That is the literal implication of negotiable in the name of the instrument. By selling the deposit to some other investor, the original depositor can obtain the value of their principal and accrued interest without suffering any penalty for early withdrawal. No penalty because there was no withdrawal of funds, simply a transfer of the ownership of the deposit. The last of the money market instruments to be discussed here are repurchase agreements and reverse repurchase agreements. Repurchase agreements are transactions between broker-dealers holding securities and needing to raise funds, with some counterparty, usually an institutional investor, that is looking to lend funds for a short period of time in a very safe fashion. Repurchase agreements are safe in part as the investor receives securities to hold as collateral. Even though the transaction is formally treated as a sale and repurchase of securities, in substance, the transaction would be more accurately characterized as a collateralized loan. Let's consider the structure of these transactions more closely. Repurchase agreements are oftentimes referred to as repos, or sometimes simply as RPs, although the formal title is sales under repurchase agreement. As indicated previously, these are transactions that take place between broker-dealers possessing securities but needing to raise funds, and some institutional investor looking to place funds for a short period of time without taking much credit risk exposure. The vast majority of repos are overnight transactions. In the exhibit, an insurance company is used as a representative investing institution, but a wide number of counterparties might engage in these transactions with broker-dealers, including but not limited to pension funds, hedge funds, mutual funds, banks, endowments, money market funds, etc. In this example, the insurance company looking to make a short-term investment connects with this broker-dealer in the repo market. The two counterparties will agree to have the broker-dealer sell a specified amount of designated securities, usually treasury or agency securities, to the insurance company for an agreed-upon amount of funds. However, at the same time, the counterparties are agreeing to a second trade wherein the broker-dealer repays the original funds plus interest to repurchase the treasury notes previously sold to the insurance company. That couplet of paired transactions is what's referred to as a repo or repurchase agreement. Repos originated as a vehicle for financing broker-dealer bond inventories. Having the funds only overnight does not allow the capital to be deployed into long-term investments. Rather, repurchase agreements are a means of broker-dealers obtaining funds to satisfy their daily net capital requirements. The bond dealers are pledging their inventory of treasury securities as collateral on the funds being borrowed to hold those securities. How about reverse repurchase agreements? Note how the diagram under the heading of reverse repurchase agreements looks very similar to the diagram on the preceding page, the diagram that was used to explain repurchase agreements. In fact, the diagrams are substantially the same, save for one significant difference. Replacing the insurance company from the repo exhibit, the counterparty the broker-dealer is trading with here is a hedge fund. However, the similarity in structure masks a substantive difference in the motivations for entering into repurchase agreements as opposed to reverse repos. By convention, if the party holding securities but needing to obtain funds initiates the transaction would be referred to as a repo. If the transaction is initiated by a party seeking to reverse in specific securities for which they will put up cash collateral, then the transaction is referred to as a reverse repo. The similarity of the structure of repos and reverses, along with the naming convention, causes some not familiar with this market segment to say that one person's repo is the other person's reverse. Unfortunately, that syllogism misses the significant difference in the underlying motivations of the parties to the different transactions. An institution seeking to invest funds at interest would not likely engage in a reverse repo, as repos typically pay a higher rate of interest than reverses. In fact, when a particular issue of securities is in high demand in this market segment, it is said to be on special, at which times reverse repos may be quoted at negative rates of interest. And that lower rate of interest earned on the reverse is not somehow offset by interest on the securities exchanged in the transaction. The securities are considered collateral. The collateral is still beneficially owned by the original holder, who would still be due any interest accruing on the securities. So what would be the motivation for a hedge fund in this example to reverse in securities upon which they earn no interest? While there are a number of possible motivations, a common reason for entering into a reverse repo is to obtain securities to deliver on a short sale. Short sales are sales of securities not owned by the seller. To those not familiar with financial markets, that might sound fraudulent or manipulative, but there are actually a wide variety of valid reasons for engaging in short sales. Short selling is often done to hedge other security holdings, for example. Another reason for shorting securities is to speculate on falling security prices. If the hedge fund in this example had sold short for any reason, it would ultimately be required to deliver the securities that were sold. As the hedge fund doesn't own the securities sold, the securities must be obtained somehow. There is an active securities loan market in which large institutions will lend portfolio securities out to other market participants. But the borrower of a security will likely have to pay the lending institution some rate of interest for the temporary use of those securities. Reverse repos are less expensive ways of obtaining securities to deliver on short sales, as the party reversing in the securities usually earns some interest on the cash collateral handed over at the time of entering into the transaction. The next segment of this module is on municipal bonds. Municipal bonds are issued by a wide variety of different entities. In general, municipal securities are debt instruments issued by the states, their political subdivisions, and duly constituted authorities. Of course, that basic description does not do justice to the multiplicity and variety of issuers of municipal debt. Aside from securities issued by the states, debt issues from other administrative districts established by the federal government are also considered municipal securities. This would include debt issued by a number of territories and protectorates of the United States, such as Puerto Rico or Guam. The state's political subdivisions that can also be significant issuers of municipal securities include counties, cities, school districts, flood control districts, highway districts, water districts, and so on. States can set up a wide variety of administrative entities to carry out governmental responsibilities and grant them bonding authority as a means to obtain financing to fund their activities. The third category of municipal issuers are authorities. There are both interstate authorities and intrastate authorities. Interstate meaning between two or more states, intrastate meaning within a single state. A prominent example of an interstate authority in the New York City area would be the Port Authority of New York and New Jersey. Often referred to simply as the Port Authority, it has responsibility for the operation and maintenance of the port and regional transportation infrastructure. The governors of New York and New Jersey each appoint half of the 12 members of the Board of Commissioners. An example of an intrastate authority would be the New Jersey State Sport and Exposition Authority. This was the authority responsible for construction of the Meadowlands Sporting Complex as a means of fostering economic development in the surrounding areas. The first structure in that development was the facility that ultimately became known as Giant Stadium, now MetLife Stadium, where both the New York Giants and the New York Jets play their National Football League games. The municipal bond market has a number of salient characteristics that distinguish it from the other sectors of the U.S. fixed income markets. By some measures, the muni market is the largest segment of the U.S. bond markets, though not by the dollar value of securities outstanding. The muni market is only somewhere between 1/2 and 1/3 of the size of the three largest sectors: governments, corporates, and mortgage backs. However, the municipal bond market is the largest by both the number of issuers and the number of issues outstanding. Recall the long list of issuers identified earlier. At last count, there were more than 100,000 issuers that had bonds outstanding. And many of those 100,000 plus issuers have multiple issues outstanding. Unsurprisingly, states such as New York or California, or cities the size of Denver or Miami, have large funding needs and have tapped the debt markets multiple times. There are more than 1 million different issues of municipal bonds in existence. Aside from those market statistics, the securities themselves have a unique feature not common to any other U.S. fixed income market segment. What most would consider the quintessential feature of municipals is the tax exemption on most interest income earned on these securities. The actual tax status is often a bit overstated, as munis are often referred to as tax-exempt securities. That is not technically correct, as the securities are not completely exempt from all taxes. Municipal bonds are subject to capital gains taxes if sold prior to maturity at a price above the investor's tax basis. It's only the interest income on municipal bonds that would qualify for any income tax exemption. Even the interest on municipal bonds is subject to income taxes under some circumstances. However, for the vast majority of municipal securities, any interest income is exempt from federal income taxes. The tax situation gets a bit more complex when considered at the state level. For most states, the exemption of interest income from taxes would still apply for any bond from an in-state issuer relative to the residency of the taxpayer. In that case, the bonds are said to be triple tax exempt, exempt from federal, state, and local income taxes. On the other hand, if a bond issuer is out of state relative to the residency of the taxpayer, the interest income doesn't qualify for the same degree of tax exemption. The interest would still be exempt from federal income taxes, but would now be subject to state and local income taxes. An example might make that abstract description easier to follow. If a resident of the city of New York purchase a bond issued by either the state of New York or the city of Buffalo, New York, or the county of Westchester, New York, any interest income on those securities would be triple tax exempt. All of those issuers are in state relative to the tax residency in New York City. Conversely, if a resident of New York City bought a bond issued by the state of New Jersey, or the city of Trenton, New Jersey, or Hudson County, New Jersey, the interest income would be subject to state and local income taxes in New York, since all of these issuers would be out of state relative to the tax residency in New York City. The interest income would still be exempt from federal income taxes, but would now be subject to state and local levies. The taxation rules, as just described, apply in about 3/4 of the states. 6 other states have no income tax at all, so local taxes are not an issue regardless of where the bond issuer resides. The other handful of states have a variety of divergent rules which are beyond the scope of this discussion. There are 2 main categories or types of municipal bonds: general obligation bonds, sometimes referred to as GOs, and revenue bonds. The names of the 2 categories are somewhat descriptive of the source of security, that is, where the money comes from to service the debt. General obligation bonds are just that, a claim against all of the issuer's revenues not previously dedicated to some other obligation. In other words, all the revenues going into the issuer's general revenue fund. Revenue bonds are backed only by specifically designated sources of revenue. There is no obligation for revenue bond issuers to tap other sources of funds to stay current on debt service should the designated sources prove inadequate to pay off the debt. The obligation to pay extends only to the funds from the designated sources. General obligation bonds are often described as being backed by the issuer's taxing authority. The phrase taxing authority needs to be interpreted broadly. GOs are backed by the issuer's full faith and credit. The implications of that wording were previously explained. Holders of general obligation bonds have a claim on any monies going into the issuer's general revenue funds, whether the money be deemed a tax revenue or designated as something else. The states and their political subdivisions may tap a wide variety of revenue sources: user fees for hunting or camping permits or stamp taxes on real estate recordings, professional licensing fees for accountants, attorneys, or security salespersons, vehicle plates and stickers and registration fees on automobiles are but a few examples. Since all sources of revenue to the issuer's general revenue funds are potentially available to pay off general obligation debt, GO bonds are generally viewed as safer than revenue bonds. However, some GOs are designated as limited tax bonds when there is a constitutional or legislative limitation on the ability to impose certain taxes or raise certain taxes beyond some specified level. Another consideration with general obligation bonds is the required pre-approval of any issuance. As this type of debt is serviced primarily by levies on local taxpayers, GOs require approval either by the voters themselves or by their elected representatives before the bonds can be sold. Also, underwriting for general obligation bonds can usually only be awarded on a competitive bid basis. The issuer cannot simply negotiate with a number of potential managing underwriters and then award the deal to whomever the issuer prefers. Rather, the offering has to be put out to bid, and if the offering is to go forward, the underwriting contract must be awarded to the syndicate that submitted the lowest bid. Revenue bonds are bonds backed by a specified source or sources of revenue. Most commonly, those are project revenues, that is, revenues generated by the facility that was built or acquired with the proceeds of the bond offering. Other revenue sources are possible. In addition to or instead of project revenues, there can be a specific tax designated as the source of funds to service the debt. For instance, a state might issue bonds to construct a highway and impose a tax on gasoline as the source of funds to pay off the debt. If that gasoline tax was the only source of revenue to pay off the debt, the bonds would be considered a type of revenue bond known as a special tax bond. To illustrate by way of example, assume a state issued bonds to construct a bridge. The bond contract, the trust indenture, specified the only funds available to both operate and maintain the bridge, as well as meet any bond interest and principal payments, are the tolls collected from the vehicles using the bridge. The issuer has no obligation to use other monies to avoid default on the bonds. That is the typical structure of a revenue bond. Revenue bonds on average are riskier than general obligation bonds because of the narrower revenue base. On the other hand, revenue bonds are easier to analyze because the analysis is constrained to the cost of constructing, operating, and maintaining the facilities, versus the project's ability to generate adequate revenues to meet those expenses. The underwriting contract on revenue bonds is normally awarded on a negotiated basis. While not required by law or regulation, municipal revenue bonds are often issued under a trust indenture, a contract between the issuer and the investors. While corporate debt is required by law to be sold with a trust indenture when offered to the public, municipal bonds are exempt from such a requirement. The narrower funding base backing the typical revenue bond means that they will usually be perceived as riskier than general obligation debt, which is backed by all revenues going to the issuer's general revenue fund. Putting in place contractual restrictions on how monies from the designated funding sources must be allocated, presumably in a fashion that would be deemed financially prudent, is designed to make investors feel more comfortable holding the potentially riskier revenue bonds. Let's illustrate municipal revenue bond trust indenture provisions with an example. Assume a revenue bond was issued to construct a toll bridge. The bond indenture specifies the tolls collected from vehicles crossing the bridge as the only funding source to operate and maintain the bridge as well as service the debt. A typical indenture provision would be a rate covenant, which would require setting the tolls high enough to generate revenues adequate to both maintain and operate the facility as well as pay the debt service. Should the revenues come up short, a rate covenant will require that rates be reset high enough to meet the anticipated future expenditures. There may be a non-discrimination covenant. That would require that all users of the same type pay the same fees, so that, say, for instance, government employees or members of favored organizations could not use the bridge at preferential rates. The issuing authority might want the flexibility to manage their capital structure and cost of capital, so they make the bonds callable. Most call provisions would be of the sort discussed in other modules, that is, early retirement at the issuer's option. The trust indenture would specify when the bonds would be callable and any call premium the issuer might be required to pay. Occasionally, revenue bonds will have a catastrophe call provision. Typically tied to an insurance feature, if a natural catastrophe such as an earthquake or hurricane destroyed or heavily damaged the bridge, the catastrophe call provision would direct the issuing authority to use the insurance proceeds to call the bonds. This would be an example of a mandatory call. Reconstruction of the bridge would require a new bond issue or some other funding source. A common provision in revenue bond indentures mandates how the revenues generated by the operation of the facility must be allocated for various project-related expenditures. Such provisions are known as a flow of funds indenture or a revenue pledge. One type is a net revenue pledge. This requires the debt service be paid out of the net revenues. Under a net revenue pledge, the first allocation of funds would be to the operating and maintenance expenses. Only after monies had been set aside to fund all of the anticipated operating and maintenance expenses for the period would any additional monies be directed to paying interest and principal. Any revenues beyond those necessary to meet both operating and maintenance expenses as well as debt service might go into a debt service reserve fund. This is a cash reserve created so that if some future period operating cash flows are not great enough to both maintain the facility and pay the debt service, monies from the debt service reserve fund can be used to stay current in meeting the interest and principal payments so as to avoid a default. After an allocation to the reserve fund, additional monies might be set aside for long-term maintenance type of expenditures in a renewal and replacement fund. While net revenue pledges are common, some revenue bond trust indentures use a gross revenue pledge. The difference between a net revenue pledge and a gross revenue pledge is nothing more than reversing the order of the first two fund allocations. So under a gross revenue pledge, debt service would be the first allocation of monies. Only after monies had been set aside to cover debt service will monies be allocated to maintain the facility, and beyond that to any reserve fund or renewal and replacement fund. The final segment of this module is on asset-backed securities. Asset-backed securities are a subset of a broader category of instruments referred to as structured securities, the other two types being mortgage-backed securities and collateralized debt obligations. The structuring involved in creating these securities is the common distinguishing feature that is not shared with securities in other sectors of the debt markets. Most debt securities represent borrowing of a single issuer. With structured securities in general, and asset-backed securities in particular, investors are receiving cash flows from an asset portfolio or collateral pool that includes obligations of many debtors. One type of structuring common to all asset-backed securities is the creation of the asset portfolio or collateral pool. The assets are typically credit instruments created as a result of some borrowing, though a variety of different asset types have been used in structuring asset-backed securities. Though a liability of the borrower, the credit instrument is an asset of the lender. The originating lender or some other sponsor creates a pool of such credit instruments and transfers title to a legal entity known as a special purpose vehicle. As the obligors make payments on the instruments in the collateral pool, those monies are collected by the special purpose vehicle, which in turn distributes the cash to the investors in the asset-backed security. Unlike agency pass-through securities in which each investor gets a proportionate share of all cash distributions, the payouts in asset-backed securities are structured so cash is paid out according to some specified priority. The foundation of an asset-backed security is the asset portfolio or collateral pool, which is to be the source of cash flows to investors. The process of creating the pool and transferring legal ownership of the instruments to a special purpose vehicle, then selling interest to investors, is known as asset securitization. The great preponderance of asset-backed securities are structured using some sort of credit instrument, the most common being credit card receivables, auto loans, and auto lease financing arrangements. Those three types of instruments account for more than a third of the asset-backed securities outstanding. However, a wide variety of different sorts of credit instruments have been securitized, including boat loans, small business loans, and student loans, among others. Even things such as legal settlements, lottery winnings, and music royalties have been securitized. A typical asset-backed security would be structured using many hundreds or thousands of credit instruments representing claims on many different obligors. Most commonly, the underlying instruments are created by a transaction between a lender and a borrower. Historically, the originating lenders would hold those instruments as interest-earning assets. But starting in the 1970s with mortgage-backed securities, then extending to a number of different types of assets in the 1980s, the originating lenders would sell assets to a sponsor doing a securitization rather than retaining the instruments as interest-earning assets. The sponsor would oversee the building of the asset portfolio and creation of the entity, usually a trust or corporation, to serve as the special purpose vehicle. Interests in or claims against the special purpose vehicle are in turn sold to investors. Once the securitization has been finished and the claims against the special purpose vehicle have been issued, the securities will generate cash flows to their holders. The obligors whose liabilities have been securitized make payments on their loans or other obligations. Those payments are initially directed to whomever is servicing that instrument, perhaps the originating lender, but possibly some other party if the servicing contract has been sold or transferred. As the servicers collect the interest and principal payments from the obligors, those monies are passed on to the special purpose vehicle less a servicing fee. Periodically, the monies accumulating at the special purpose vehicle are paid out to investors. The payouts to investors are structured in a variety of different ways, some of which will be discussed shortly. Let's consider in some detail the two most common types of asset-backed securities: auto loan asset-backed securities and credit card receivable asset-backed securities. First, auto loan ABS. The underlying credit instrument for an auto loan asset-backed security is created when a car buyer is financing the purchase of an automobile. Naturally, if the buyer pays for the car in full with money they've accumulated, no credit instrument would be created. But in most instances, the purchasers are borrowing the majority of the cost of the vehicle. Some loans are arranged directly between buyers and businesses for which lending is a core activity, such as banks, credit unions, or specialist auto finance companies. Many loans are made indirectly via the buyer arranging for financing with the dealer, though the actual loan funding is usually provided by a traditional lender. Until the mid-1980s, most auto loans would have been held by the originating lender as an interest-earning asset. About that time, financial institutions started bringing the structuring technology developed in the mortgage-backed securities markets to other credit sectors. Sponsors, in some cases Wall Street banks, in other instances the auto finance companies themselves, would set up a special purpose vehicle as the legal entity to hold the loans. A portfolio of auto loans would be acquired from the original lenders and transferred to the special purpose vehicle. Once an auto loan pool had been created, units of interest, the auto loan asset-backed securities, would be sold to investors. The earliest asset-backed securities were typically structured as pass-through securities. Similar to Fannie Mae or Freddie Mac pass-throughs, all investors would receive their pro rata share of both interest and principal each period until all of the principal was returned. Such payout structures became very uncommon a long time ago in the asset-backed securities market. Since the late 1980s, it's most common for a number of different classes of securities, known as tranches, to be issued in an offering of auto loan ABS. In other words, the payouts are structured in a fashion similar to collateralized mortgage obligations. Thus, even though investors in all of the tranches are paid interest, the principal is returned to the different tranches according to a specified priority. Most auto loan ABS structures have a relatively small number of tranches, perhaps a half dozen or so. In many auto loan ABS, all of the tranches, even the most subordinated tranche, will have an investment grade rating. In the hypothetical structure you're looking at here, there are a total of 5 tranches, A1 through A4, the senior tranches, and B1, the subordinated tranche. In this example, all of the tranches have investment grade credit ratings. Whether the most subordinated tranches end up with an investment grade rating or a less than investment grade rating would depend on the quality of the loan pool, the amount of credit enhancement, and investor preferences, among other things. If the auto loan pool was comprised of subprime loans and there were no credit enhancements beyond the subordinated tranches, one or more of the tranches could have a less than investment grade rating. Auto loan ABS tranches are primarily sequential pay. That is to say, the principal will not be returned proportionally to all investors each period. Rather, the principal will be returned to investors in the different tranches in a sequence prioritized primarily by seniority. The senior-most tranche will receive its principal first. Only when the first tranche has been retired in its entirety would the second senior-most tranche receive principal, and so on. Conversely, credit losses beyond any other credit enhancements are allocated initially only to the most subordinated tranche, known as the first loss piece. Only after the most junior tranche was written down to 0 due to credit losses would any further credit-related losses reduce the principal of the next junior-most tranche. Tranche A1 is rated P1 or Prime 1, the highest credit rating for a money market instrument. Typically, the shortest term senior tranche in an auto loan ABS is money market qualified, which means it is eligible to be purchased by money market mutual funds. Return of principal in this structure would be initially to A1. Credit losses would be allocated to the subordinated tranche. In general, the principal is returned sequentially to tranches A1 through A4, after which any remaining principal is paid out to the subordinated tranche until it is retired. The last of the securities to be discussed are credit card receivable asset-backed securities. Credit card receivables are credit instruments that result from the use of a credit card to purchase some good or service. Say, for example, some patron at a restaurant decides to pay for their meal with a credit card. Use of a credit card to make payment means that the issuer of the credit card is providing the restaurant with the funds to pay for the meal. As a result of that transaction, the credit card holder now owes the amount borrowed to pay for the meal to the credit card issuer. Thus, a credit card receivable was created. Until the 1980s, credit card receivables were typically held by the credit card issuer as an interest-earning asset. With the advent of asset securitization, issuers of credit cards had the opportunity to borrow money more cheaply by issuing credit card receivable asset-backed securities compared to the rates they would have to pay if raising funds by issuing unsecured bonds. The credit card issuer would act as sponsor, set up a special purpose vehicle, transfer a portfolio of credit card accounts receivable to the special purpose vehicle, then sell units of interest to investors, the units of interest being referred to as credit card asset-backed securities. The average life of a credit card receivable is relatively short-term, typically somewhere between 6 and 18 months. The expenses related to creating the legal vehicle and distributing the securities would make structuring these offerings extremely expensive if limited to the life of some initial portfolio of credit card receivables. This characteristic of credit card receivables results in a significant difference in the structure of credit card ABS compared to mortgage-backed or auto loan asset-backed securities. For MBS and auto loan ABS, there are no additional loans added to the asset portfolio after the origination of the securities. In those structures, the loans pay down over time, and the asset portfolio gradually amortizes away. Because of the short lives of the typical credit card receivable, additional receivables will be added to the special purpose vehicle to extend the life of credit card ABS. We'll consider the life cycle of a credit card receivable ABS in just a few moments, but first a few words about the special purpose vehicle. Initially, as the market for credit card receivable ABS was developing, issuers would create a separate trust to serve as the special purpose vehicle for each new offering of credit card asset-backed securities. To reduce that expense, over time the legal structures evolved to what are now master owners trusts. As the credit card issuer has more credit card receivables on its books, it can deposit additional accounts receivable into the master owner's trust and use those additional receivables as the basis for a new issue of credit card receivable asset-backed securities. However, each group of receivables is not ring-fenced so that specific receivables are backing a particular issue of asset-backed securities. Rather, all of the accounts receivable in the master owner's trust back all of the credit card ABS issued against that trust. Now consider cash flows to investors in credit card receivable asset-backed securities. Since payments to investors are derived from credit card receivables in the trust, the manner in which the credit card holders pay on their accounts have implications for the principal balances on the receivables held in the special purpose vehicle. How do account balances vary over time? Of course, it depends on behavior of the cardholder. Some cardholders pay their accounts in full every month. Others make only the minimum payment. Some pay less than the amount of charges on the card in that period, so the outstanding account balance increases. The amount of the outstanding balance on a portfolio of credit card accounts receivable could fluctuate up or down from month to month in an unpredictable fashion. That's reflected in the diagrams on this page. The vertical axes represent the dollar amount of the outstanding balances on the credit card accounts in the special purpose vehicle. The horizontal axis represents the life of the credit card ABS. The varying outstanding balances are represented by the jagged blue lines running horizontally across the two diagrams, illustrating the uncertainty regarding the balance on the credit card receivables over time. Such uncertainty about the amount of principal upon which interest is to be paid would be a feature many investors would find unattractive. Future cash flows would be near impossible to project even if the securities paid a fixed rate of interest. Investors are spared that uncertainty as the credit card issuer that acted as sponsor retains an interest in each securitization. It's the sponsor's interest that will bear that change in the principal over time. From the investor's perspective, the principal is constant through the entirety of what is known as the revolving period. 5 years is a common maturity for an issue of credit card receivable ABS. The first 4 years would be a revolving period, the the final year being the amortization phase. No principal is returned to the investors during the revolving period. Any principal repayments by the card holders during the revolving period will be reinvested in additional accounts receivable. So during the revolving period, investors are only receiving interest. By reinvesting cardholder principal payments in additional receivables, the investor's principal is held constant throughout the revolving period. Though the two diagrams here show the same variation in principal outstanding over the first 4 years, the final year cash flow patterns differ, reflecting the two common types of amortization found in the credit card ABS market. One type, known as controlled amortization, is reflected in the upper diagram. Notice how in the final year, the blue bars, which represent the amount of outstanding principal, are declining at a measured pace over the course of the year. Cash is paid to investors monthly, and they are receiving 1/12 of their principal back each and every month of the final year. In addition, interest on the still outstanding principal is also paid. This structure is known as a controlled amortization because the principal is being returned according to a set amortization schedule. The other structure, illustrated in the lower diagram, is known as a controlled accumulation. From the investor's standpoint, the principal of their investment is constant over the entire 5 years. However, in the final year of the structure, the sponsor is gradually setting aside the original principal month by month in equal installments. 1/12 of the original principal amount of the credit card receivables are being sold, the proceeds invested in high-quality money market instruments. From an investor's perspective, the controlled accumulation operates just like a term bond, where all of the principal is returned at the ultimate maturity.